Good morning, dear students. I am Ms. Vandana Pai. In today's lecture of the subject Global Finance, we will be studying the scope and significance of international finance. Okay, so let's see what is the scope and significance of international finance. Okay, now international financial management of an organization is a complex process. It involves its own methods and procedure. It is made even more complex because of the globalization that is making the world's financial and commodity markets more and more integrated. So, this process of integration is both across countries as well as markets. Okay, not only the markets but even the organizations, they are becoming international in their operations and approaches. This changing scenario makes it imperative for professionals pursuing advanced financial management courses to study the field of international finance. So, let's see what is the scope of international financial management and understand why it is essential to study it. Okay, the scope of international financial management. Actually, the main objective of international financial management is to arrange sufficient funds for meeting the short term and long term goals of an organization. A financial manager has to concentrate on the following areas of international finance function. Okay, the first one is estimating the financial requirements. Okay, means the international financial manager is required to estimate the financial requirements. Okay, so first of all, what he is supposed to do, okay, his fundamental responsibility is that is to estimate the short and long term financial requirements of the business. Okay, so for this he is supposed to demand, the finance manager is supposed to prepare a financial plan for the present as well as future, okay, based on the past financial data of the business. Okay, this includes estimating the amount required for purchasing finance fixed assets as well as the working capital. See, in while estimating the financial requirements, what he is supposed to do, yes, he is supposed to, yes, consider his future needs, his business future need, and as per that he is supposed to plan financially. Okay, so after that, what we are required to do, yes, as a finance manager, yes, he is supposed to estimate short term as well as long term financial requirements of the business. Okay, he's supposed to forecast, he's supposed to forecast as per his forecast and all. Okay, after his predictions, after his forecasting, okay, determining the future itself, what he can do is, yes, he can tentatively prepare a plan through which, yes, all the financial purposes will be fulfilled. Okay, so he is required to estimate the amount required for purchasing a fixed asset as well as working capital. Okay, after that he is supposed to, yes, deciding capital structure. Okay, see the capital structure. What is capital structure? Yes, the composition of your capital of your business itself is included in capital structure. Okay, the capital structure refers to the kind and proportion of different securities for raising the required fund. Okay, means for properly operating your business, yes, for properly operating your business. Okay, the different securities whichsoever you do need, okay, those securities, they are included in capital structure. Okay, after deciding about the amount of funds required, okay, you are required to, yes, decide which type of securities should be raised. Okay, see the funds available with you. Okay, as per the funds available with you, what you are required to do, yes, you are required to decide the type of securities which should be raised. Okay, it may be wise to finance the fixed asset via long term debts and current assets via short term debts. Okay, so whenever you consider, yes, whenever you consider the capital structure, what is required? Yes, capital structure involves debt as well as the securities, as well as it does includes, okay, the source of capital through which you will be raising the funds for your organization or for your business. Okay, so here the manager, financial manager, he is required to consider all the funds requirement, okay, and as per that, okay, whichever is suitable for the business, okay, as per the type of business, what they can do is, yes, they can raise the securities. Okay, so as per that, the long term as well as short term debts can be prepared, or the arrangement for it can be made. Okay, then selecting a source of finance. After preparing the capital structure, yes, from where you can raise the funds, from where you will be getting the finance. This is the another question which arises in front of the finance manager, is it? So after preparing for the capital structure, what you are required to do, yes, the appropriate source of finance needs to be determined. Okay, various sources from which finance can be raised, okay, which include share capital, debentures, financial institutions, commercial banks, public deposit or equity, etc. If finance is required for short term, then a bank, public deposits, and financial institutes are appropriate. On the other hand, if finance is required for long term, share capital and debentures might be useful. Okay, then so here, the financial institutes who will be financing you adequately, you are required to search for it. Okay, so selecting a appropriate source of finance, okay, which or who will be providing you adequate finance and regular. Okay, the flexibility or frequency, it should not be changed. Okay, whensoever you are required to have capital, they should be able to provide it to you. Okay, so such type of source of finance you are required to raise. Then trends in international trade and cross border financial flows. Okay, what is it? See, what is going on in the international trade, is it? What are the new trends, what is going on in the international trade? Okay, and the cross border financial flow. Okay, how the finance is flowing, or how the funds are flown from across the boundaries. Okay, you are required to see the international trade trends as well as the cross border financial flows. Okay, so globalization essentially involves the various markets being integrated across geographical boundaries. Okay, integration of financial markets involves the freedom and opportunity to raise funds from anywhere in the world and invest it anywhere through any type of investment. Okay, though the degree of freedom differs from country to country, the end is towards having reduced control over the international markets. As a result of this freedom, anything affecting the international financial markets in one part of the world automatically quickly affects the rest of the world. Okay, so due to globalization, what has happened? Okay, anywhere in the part of the world, if anything happens, okay, which badly affects the international trade, okay, it will surely affect all the places in the world, okay, and all the countries in the world. Okay, so whatsoever is going on in the international trade and as well as in the cross border financial flows, okay, the financial manager, you should be able to determine it. Okay, then bottom line. Okay, what is bottom line all about? Companies operating in international markets are not the only ones that need to be aware of complexities of international finance. Okay, even the companies operating in domestic markets need to understand the issues involved. To understand the concept of international finance, you may need the guidance of an advanced financial management course, okay, or you might consult someone, is it? So here what you are required to do, yes, the companies operating in the international markets, they are required Okay, these people, they are required to see the complexity of international finances. Okay, even they are required to see the domestic markets. Okay, though the people who are working in the domestic market, they think that the international market, it does not have impact on them. Okay, but it is not true. Yes, surely whatsoever will affect the international finance as well as international market, surely it will be having some impact on the domestic market. Is it so? Then let's see what is the significance of international finance. Why international finance is important? Okay, see, international finance, it is related to business decisions such as asset selection, resource allocation, and financial management, which is very important from the organization's viewpoint. Okay, see, means what is the requirement of fixed asset, what is the requirement of the current asset, is it how much resources do you need, okay, how much funds should be allocated to the assets, okay, how to manage the finance of the organization effectively, is it all these aspects, they are very important in the international finance. Because okay, when you go international, okay, or whenever you operate in the international market, what happens? See, okay, you should be having adequate funds, or else what will happen, your project will go fail, is it so? Whenever we consider the international finance and its importance, okay, it can be considered into three ways, okay, into four ways: for business firms, for investors, for central banks, and for regulators. Okay, from these four viewpoints we can go through the significance of international finance. So let's see what are the significance of international finance. Okay, first, for the business firms, see, every firm, it does faces the four important decision making areas in financial management. Okay, what are these four areas? First one is investment decision, second one is financing decision, third one is working capital management decision, fourth one is dividend decision. Okay, see, investment decisions, okay, means where to invest the funds, right? Okay, firms with a presence in different factors and product markets have to decide with the complex issues related to, yes, how to set up the new plant, okay, what should be the capital structure, where to raise finances, how much cash to hold, which currency to choose for denominating receivables and payables, the sources of short term funds, and whether to pay dividend or not are the routine areas in financial management for which standard evaluation techniques and management methods exist. Okay, however, in the globalized scenario, each decision acquires layers of complexity as it needs to be taken in context of differences between countries in their political and judicial systems. Okay, so when an MNC decides to set up or acquire an affiliate overseas, it conducts a financial evaluation. A capital budgeting proposal is evaluated in accordance with accepted measures such as NPV and IRR. But an overseas capital budgeting proposal involves exchange rate forecasting, political risk assessment, and tax planning. Differences in corporate tax rate between countries, availability of subsidies in the host country, and displacement of profits from exports must be accommodated into the framework of the overseas capital budgeting evaluation process. Okay, then the financing decision. Okay, once the location is chosen, the next question is how and from where the money needed for the project will be raised. Okay, this is essentially related to capital structure. Okay, here, what are the various sources of short term, medium term, and long term funds? Okay, what is the distinction between global depository receipts and American depository receipts? Okay, all these things, they are required to be evaluated. All these things, they are required to be evaluated. So then it is working capital management decision. Okay, means what is the composition of working capital whichever you require. Okay, how much working capital is required. Okay, and MNC's numerous inter-affiliated transactions affect tax collection in respective of host countries and offer opportunities to the parent company to reduce conversion cost. Okay, suppose an MNC has three affiliates A, B, and C located in different countries. Okay, what is the source of raw materials? Okay, how much raw material is required? Okay, whether in that raw material production activity will be completed. Okay, all these decisions they are included into working capital decisions. Okay, then it is the dividend decision. Okay, see, shareholders they have invested their funds into your organization, you are required to pay for them, is it? So in the same sense, okay, the objective of moving funds from a country with a higher corporate tax structure to one with a lower tax structure, okay, the result is that, okay, low tax burden, to lower the tax burden, is it? So considering all these things, okay, what you are required to do, you are required to also go through the, yes, dividend decisions. Okay, how you can have lower tax, is it? Or else it will badly affect your profit rate, right? Okay, then for investors, see, the exchange rate movements affect returns from overseas security holding. That is, the expected return on the security is not the sole factor that determines the investors' buy decisions. Exchange rate risk is equally important and it has to be factored into the decision making process. Foreign portfolio investments move between overseas market in search of investment that offer a higher return. Returns in foreign currency get neutralized by adverse exchange rate movements. Of course, the reverse can hold, and favorable exchange rate movements can magnify the portfolio return. It is important to be able to forecast the likely exchange rate at the end of the holding period. Exchange rate forecasting plays a significant role in portfolio destination. Speculators play an important role in the foreign exchange market by imparting liquidity. So, whenever we consider the investment for investors, okay, it should be profitable, right? Okay, so individuals are also concerned with exchange rate movements in their capacity as depositor and investors. When they are free to move their deposit between countries, they compare interest rate and factors in effect of exchange rate on their holding. Then for the central banks, okay, central banks are also the investors too. Okay, since the RBI holds a portion of its foreign exchange reserves in the form of US Treasury bills, dollar depreciation affects the rupee value of its portfolio. Okay, commercial banks play an active role in foreign exchange market all over the world. They lubricate the working of the foreign exchange market in a country and often serve as the link between the foreign exchange market at home and in the international countries. Okay, they buy and sell and hold various foreign currencies on behalf of their clients. Okay, and offer two-way quotes in multiple currencies. These quotes are extremely competitive since the rates change on a daily basis. Banks are keen observers of demand and supply imbalances on exchange rate. Okay, so the central banks, what they do, okay, the central banks need, okay, need to solve the exchange problems, is it? Okay, the commercial banks they do, a commercial bank they do um, play a role of the step of exchange on behalf of central bank. Okay, so when a country's financial market lacks a currency derivatives, okay, then what they can do is they can approach the central banks. Okay, the fourth one for regulators, okay, the flow of capital between countries is dependent on capital controls. The removal of capital control requires careful sequencing and must be preceded by the creation of institutional structures ensuring the stability of the financial system. The fewer the controls on capital movement, the greater is the financial openness of an economy, and the better the chances that domestic financial market will get integrated with financial markets in the other countries. In other words, capital account convertibility is used as the predecessor to financial integration. Developed countries are characterized by open financial systems in contrast to the financial market of many developing countries. The benefits of financial openness include higher inflows of private capital in the form of FDIs and other. Since capital inflows are associated with development, employment generation, and growth, there must be sought after. But continuing inflows cause domestic currency appreciation. Okay, so as a regulators watch the foreign exchange market. Okay, and they do take the efforts to yield the expected results. So with this, we do conclude today's lecture. Thank you.